Hey everybody, what's up? It is Monday, August 12th. The new issue of MMT Trader has been sent out. If you want to get a copy of that, go to my website, pitbulleconomics.com. So, hey, what happened today? We had a pullback in the market. Let's talk about that. As you know, last week I spoke about August 8th being the window, August 8th, thereabouts, being the window for the bottom of the stock market correction based on the reserve flows. And of course, I've been talking about reserve flows for a long time, for months and months and months. And these are tradable cycles. All right. As I've explained many times, you have billions, tens of billions, sometimes hundreds of billions moving into the banking system, causing banks to have to adjust their asset mix because they are subject to certain regulatory requirements. And you have tens of billions and hundreds of billions flowing out of the banking system as a result of treasury sales, which now have resumed because the debt ceiling has been suspended, and also because of normal taxation. So you have these flows. These are like the tides coming in and going out. And they have an effect, and they are absolutely tradable. Now, I'd like to say that every single time I can pinpoint the exact date. And I have to say that in the last 2 or 3 of these cycles, they've pretty much been at the exact date. And we may even end up to see August 8th as being the exact date, although now it's pulled back pretty much down to about that level, maybe even slightly below that August 8th level. I haven't looked, but today's what? 391 decline in the Dow. I didn't look at the S&P, how much it was down, but it's close to where it was on that August 8th. Anyway, that's besides the point. We've got to look, when some time elapses, we can go back and check this out, but I'm very, very confident. What is going on? First of all, 2 things. Number 1 is, again, we had some deterioration, some selling in RMB, the Chinese yuan. That crossed over 710 or 711 threshold. Now, let me say this, that downward move in the Chinese currency, RMB, that is psychological, all right? That is not systemic, and there is nothing particularly long-term negative about that, all right? This is, well, I've equated it to the decline in the long-term decline in the US dollar since delinking from gold in 1971. The dollar became the world's reserve currency. Over time, it has gone down. It's been a very slow, gradual process. You could see it clearly if you look at a trade-weighted index of the dollar. It has been going down for the simple reason that it has been in demand. Now, I know that sounds counterintuitive, but money is created as a result of demand for that money in a fiat system. Under a gold standard or under a fixed exchange rate, it's a different story. So don't conflate the 2 things. But under a fiat system, right, where money literally, I know a lot of you like to say printed or gets created by decree, the demand for money either as a consequence of demand for credit or as a consequence of the non-government, people, firms, whatever, demanding services or supplies or something from the government, social support, services, infrastructure, whatever. So those 2 things, either it's the demand for credit, and the government is involved in that too, because, okay, banks could create a loan, but then the reserves are supplied by the central bank, or the demand by the non-government for the government to provide things. It could be income, it could be infrastructure. Okay, so it is the demand that creates the supply of money, the new supply of money under a fiat system. Again, don't conflate that with a gold standard or a fixed exchange rate. So my contention all along has been that the pressure, the downward pressure on the Chinese currency is due to its rising status, its growing demand. Now remember, the Chinese currency, I don't know if it was 2 years ago or something like that, was included in the IMF basket of currencies for the first time. So it's legit. And it's been operating under kind of a soft peg or a dirty peg, we might call it, that the Chinese government has imposed on it. But now it's letting it go. And I do not see, and I think I would be correct in stating this, that there is not really any foreseeable long-term negative consequence to this. Chinese economy still growing at 6% plus. All right, maybe that's down a little from historic levels where it was like 7 or 8 or whatever it was. But look, 6% growth is growth that any Western industrialized or any modern industrialized country other than China would be tickled pink to have that level of growth. But people are looking at this and freaking out. Number one. Number two, the decline in interest rates. Now that is a more complicated thing, I should say. First of all, what is being read into the decline in interest rates, and in some cases it's historic. I mean, outside the United States, there are many countries now that have negative rates. Here in the United States, the 30-year bond yield is approaching an all-time record low. The perception on the part of the market, on the part of investors, is that this decline in rates is a forewarning, a predictor of an oncoming recession. Now, as you know, I have taken the opposite point of view on that. I have taken exception with that. And I said here in videos that I have made previously that if we do end up in recession this year or even early next year, feel free to attack me and criticize me with everything you got. I believe this is a misreading of what is going on. So, what is going on? My assertion up until very recently was that two factors, the debt ceiling and the engineering by the Fed of reserve balances down, created a squeeze, a shortage in the bond market. Banks had to replace those lost reserve balances, which are tier 1 non-risk assets, with other tier 1 non-risk assets, those being treasuries. And you could see this very clearly in the data. The accumulation of treasury and agency securities, these tier 1 non-risk assets, just blew through the roof at the time we hit the debt ceiling. Debt ceiling has been lifted. The engineering of reserve balances lower has stopped by the Fed. Treasury sales began last week. So I still think we're wrapped up in this kind of technical situation where the pressure, it'll take some time, but it'll be alleviated. Now, here's where I could be wrong. And I said this months ago, that it looks to me like all of these central banks are now going full Japan. I said this a long time ago, and maybe it was a mistake not to flip around my position at that time, but I didn't think the Fed was going to buy into this. I really didn't. Full Japan meaning negative rates, asset purchases. This becomes the new orthodoxy, the new paradigm. I never thought this could happen because it really runs counter to central banker mentality, with the exception of what we saw in Japan for a long time. But then when they started saying, hey, look at Japan, we might need to go in that direction. And that would explain it as well. So, bottom line is, at least with respect to bonds and rates, got to give it a little bit more time. Stock market, the monetary condition, the fiscal condition, very strong. By the way, let me just throw in one thing. If the economy was really slowing down, in the numbers, bank credit that I go over every week, rising at the fastest pace in 30 months. Consumer loans rising at the fastest pace in 10 months. Credit card, revolving credit rising at the fastest pace in 16 months. Auto loans rising at the fastest pace in 28 months. All right. Real estate loans rising at the fastest pace in 6 weeks now. I mean, you wouldn't see this if the economy was going towards recession. So we'll see, but I'm pretty sure I'm right. See everybody tomorrow. Bye-bye.